special honor, a repeat speaker, Michael Linse from Silicon Valley, from a famous VC called Kleiner Perkins, Cofield and Byers. And here's your clicker.
Thank you.
Okay. Exactly like this.
Okay.
Yeah.
Hi. My name is Michael Linse. I'm a partner at Kleiner Perkins. And I wanted to talk to you about a framework I use for thinking about green tech investing. So let me start by talking about the framework. I think about two major drivers for green tech investing, frankly, over the next generation. Number one, resources have become and will continue to become a lot more expensive. And there are two reasons for that. One is just a tremendous shift in the demand curve for resources. So if you've been impressed by the number of people that have joined the global middle class over the last 20 years, just wait to see what happens over the next 20 years. And second, at exactly the same time, the cost of extracting those resources has gone up quite dramatically, and I'll talk about that a little bit more later. While the value of resources has increased, the attractive thing from investors' perspective is that many of the substitute technologies show extremely steep cost curves. Don't worry, I'm not going to spend a lot of time talking about that. I spent my entire speech the last time talking about cost curves. I'm pretty obsessed by that. If somebody is not convinced that these technologies have steep cost curves, you can corner me afterwards and I can bore you to death with data on that. So this, I find this to be a fascinating slide, which I shamelessly ripped off from McKinsey. What it shows you is that basically the huge increase in resource value that we've experienced, especially over the last decade, has brought us to the point where we have about 2 billion people in the global middle class. Well, we're going to have about 3 in about a decade from now. We're going to have about 5 in another a decade after that. And so this trend is not flattening out. There's nothing to suggest that the demand side of the equation is changing. In fact, the direction I would argue is going to intensify. And unless you believe that, especially all those people in Asia Pacific are going to stop striving to basically get out of abject poverty and move into the middle class, this trend is not going to change. The reason the middle class is so important to focus on is because when you leave sort of the scope of poverty and move into the middle class, that's when your consumption pattern in terms of actual physical resources changes most dramatically. It's a pretty intuitive thing. You start driving cars, you start building houses, you start putting in dishwashers, you start putting in washer dryers, and you start going on vacation. So your resource consumption changes dramatically. The developed world has gone through this. It's going to be awe-inspiring when the rest of the world goes through this over the next 2 decades. So while this is all happening, on the demand side, we've got the unfortunate situation that the cost side isn't looking very good. So there are a lot of examples. I'm going to focus on one in particular. I thought this graph was really interesting because what it basically shows is that since about the mid-90s, it takes about 50% more ore to create the same tonnage of copper now as it did in the mid-1990s. And this at a time when the cost of energy to extract that ore has probably gone up by a factor of probably at least 3, probably more closer to 4x. So you can basically have a very similar graph for all sorts of other commodities, for oil, for agriculture. And oil, I mean, you used to be drilling in exotic places like Texas onshore, and now The new finds are miles underneath the water off the coast of Brazil or in the oil sands of Canada. And these new projects require break-even oil prices in the 70s and 80s, if you believe the oil companies, and probably higher than that. So the days of $40 oil prices are gone, and the days of very low metals prices and commodity prices are gone as well. So to believe that there's a paradigm shift, you don't just have to listen, to the macro arguments that I'm making. You can also just look at the prices. And the price shift has been so extraordinary over the last decade that I think it's important to look at this in an historical context. So if you look at this chart, what you see is that over the course of the 20th century, commodity prices, broadly speaking, have dropped by about 50%. So it's a pretty, there have been minor interruptions along the way, but broadly speaking, it's been a pretty consistent pattern of commodity price decreases. And then all of a sudden, starting in the last decade, that shift, this is, by the way, inflation adjusted, that shift has reversed, and it's more than reversed. Frankly, I don't see that trend changing. In fact, if you just look at the price development, as one of my heroes, Jeremy Grantham, the famous value investor, said, the shift in prices has been so extraordinary relative to the mean of the historical mean of the prices, 2, 3, 5 standard deviations, that just that price shift alone should tell you that there has been a shift in the paradigm. The chances of this happening broadly across, coal, iron ore, coffee, sugar, oil, rubber, and it just being an aberration are pretty small. So I look at this thing and I can't explain to myself why this trend would change. On the demand side, I don't see this changing, and on the cost side, I don't see this changing. So this looks like humanity about to hit a wall, to me. So the good news is, I always have to put this slide up in every presentation because I'm in love with it. The good news is, and by the way, I could put this up for, as I said, batteries, LEDs, et cetera, for a broad range of technologies. These cost curves look more or less similar. The good news is, we're kind of hitting these demand and supply pressures for resources at about the same time as a lot of these technologies are hitting parity. Certainly for solar, where I live in California, solar cost has basically hit parity with the grid. And what do you see? You see explosive volume growth happening in those markets. And again, if solar decreases by 10, 15% a year, it's going to start to hit other markets that will become viable even without generous government subsidies. So putting that all together, I wanted to go through what I saw in terms of implications for folks investing in the green tech sector. While a lot of the constraints that we're seeing, and by the way, these are constraints that I would talk about in terms of a decade, a multi-decade perspective. You will have aberrations along the way. There's a high likelihood we will have another financial crisis. There's a high likelihood China slows down along the way. There's a high likelihood that we will discover another phenomenon like the shale gas phenomenon. But the broader theme is what I think is important if you look at clean tech investing over a long time horizon. And the attractive thing from an investor's perspective, I think, is that these resource constraints and the cost curves sort of come together such that very, very large industries are being transformed. These are industries that are hundreds of billions and trillions in size. The automotive industry, the power industry, the waste industry, the lighting industry. These are big, big markets, and these are trends that are not short-term in nature. These are long-term trends. So as an investor, you can relax. This is not going to go away. You're not going to miss the opportunity to invest in a change in these sectors. This is going to go on for the rest of your life. And so relax, and also stop worrying about a technology coming along that's going to fundamentally transform a sector. In fact, I don't know of a single example where all of a sudden a technology came along, a company commercialized, and the sector was transformed in the normal investing horizon of a venture or private equity investor. I don't think that is really, that should be the focus. I think it's been the focus a lot in the green tech space. I think the focus should be markets. And I'll give a great example. I would doubt that anybody in this room still believes that having a slightly better solar cell technology is actually going to be a significant factor in how well of an investment a solar manufacturer is relative to the much, much more important, in my perspective, macro trends of intense competition, Chinese dumping, and just very, very steeply sloped cost curves across a broad range of technologies. And so I think it's important as an investor to focus on companies that have highly attractive business models and that are changing industries over time versus focusing on a specific technology. I think it's if you look back over the last 5-6 years, I think the driver for returns has been being right about major industry trends. And so if you just look at the last years, you wanted to be a buyer of batteries, not a manufacturer of batteries. You wanted to be a distributor and financier of solar panels, not a maker of solar panels. You wanted to be a buyer of LED dyes, not a maker of LED dyes. And so getting those key trends right, I think, is most important. As these industries go through dramatic change, we're going to have extreme volatility. And so, if you make an investment and it depends on oil prices not going back down to $40, don't make the investment, because it could very well happen. We've just seen it. We've just gone through one of the most dramatic financial crisis of our lifetimes, and we saw oil going back down there, but it's right up there, even though the recovery hasn't been particularly strong. The other thing is just green tech, as I explained, is really the impact of these macro trends on huge industries, and I just think it's very difficult to be an expert on green tech broadly, because it's the equivalent of being an expert on all industries, because a huge percentage of GDP will be affected by these macro trends. And finally, many of the most attractive investments don't come in the primary industries, but come around the edges of those industries. Ancillary industries have developed over the last 5 years that frankly didn't even exist 5 years ago, whether you think about things like EV charging infrastructure or cell phone refurbishment, etc. These are industries that basically were very small or didn't exist just 5 years ago. So in summary, I think the macro trends around green tech investment are extremely healthy and are generational trends. I think some mistakes have been made in terms of investment focus over the last decade of green tech investing. But I think if the focus is on living by sort of the learnings of the venture and the private equity industries, there's going to be a lot of opportunity to come. So. Sure.
We can do a couple of questions to Michael. Anybody in the room has a question to Michael, please raise a hand and wait for the microphone. In the middle.
Stefan Decher, Clean Capital. I noticed that you called the sector Greentech rather than Cleantech. And I was wondering what the thinking behind that is. I know that the US looks at the sector differently to Europe. It's much more politicized. And how do you see the investment take-up in the US versus Europe and also Southeast Asia? China is actually now much more the driver than other parts of the world.
Yeah. So I actually, I don't, whether it's Cleantech or Greentech, I look at it as in general, just, I look at it frankly as there are some huge macro drivers that are glaringly obvious, and they will lead to a more sustainable functioning of many, many industries. And whether you want to call that Greentech or Cleantech, what I want to get away from is the historical definition, which in my opinion was more focused on generation of electrons versus on broader sustainability, which is certainly the focus my fund has.
Another question? Okay, let's have lunch. Thank you very much, Michael.
Cheers.